Hey there, it's Julie Broad with Revenue, and I'm here with Dave Penyak, my husband and real estate investing partner, and of course partner in Revenue as well. And Dave has been spending the last 30 days or so testing out the RealData software analysis programs. They're basically analysis tools for real estate investments, both commercial and residential. And they have some pretty powerful tools and analysis capabilities. So we're going to run you through that and tell you what we like and don't like about it. And if you have questions, of course, you can always get in touch with us through revenue.com. Okay, Dave, so why don't you just show us what it looks like and maybe do one quick analysis using it so we can get a feel for the software.
Right now you can see there's only 5 tabs down here. So it's very, very simple, very, very quick and easy. And that's because I've selected Quick Analysis, which is a nice feature that they have. And they tell you a little bit about the analysis mode here. You can see with the red tab, as I mentioned, they actually explain why you might want to use the quick analysis versus the detailed analysis. With most single-family duplexes, more simple, smaller residential properties, quick analysis is probably the way to go. But you can expand it to detailed analysis. So right now, as I said, there's only 5 tabs down here. If you go to detailed, whammo, there's a whole bunch more. You can see annual property operating cash flow and resale analysis, loan amortization, and it goes on and on and on. It even gets into whether it's better to lease versus buy if you're an owner-occupier. So say you have a business, you're a real estate investor, and you want to have your own office and you want to buy a commercial building. Well, maybe you want to work in that building, and maybe you can lease out the other 3 or 4 commercial office spaces that are there. This will allow you to actually compare whether it's better for you just to lease some office space yourself or to buy a building and more or less lease it off yourself, and maybe if there is some other potential income from that building, it'll compare that out, which is quite a handy feature. So you can, but we also have a partnership analysis, which I thought was really handy. And you can look at, you can put in your partner. These are all pre-populated. I haven't added any of these. But really, you can just add in what their contribution is, say $36,000 for one partner, $36,000 for another partner, and that will show you actually what percentage they have provided in relation to the total contributions, which is nice as well. So what I've done with the quick analysis is I just put in a recent property we bought in Kelowna, but I just threw in some of our data from that purchase, and you can see here you put in the where it is and what the name is, whether it's single family. There's a whole bunch of different things in here. I just chose single family because that's what it is. Now, when we get into the meat of it, it's really about the quick analysis, and this is where you want to put in all your numbers. You can see here that, remember where I had mentioned earlier, the blue is where you fill it in. The black is pre-populated, so that's a formula. You don't put anything in there. So we bought it for $351,500, so I put that in. This was calculated. You can see there's a formula up here, and so you can't do anything to that. If I try and change it, we get this handy little, hey, don't do that. Financing, we did 75% financing, which gives you, again, this is, you don't touch this. This is a formula. And you can see it there. Basically what it is $351,500 times 75% LTV is that amount. And to get this amount is basically 351 minus 263 plus the 8,000, right? So click. Then there's a few other factors in here. Term of your loan in months. We did 35-year amortization to help increase our cash flow and keep our debt service costs or our mortgage costs down. Put in our annual interest rate, we got 3.74. Here you can actually increase it annually. So say you had a private lender and they wanted a greater percentage each year, you could increase it there. You can also do an interest only. And then for how many months? So you could do 12 months for interest only. And you'll see a few things do change when you make that addition. But with the standard addition that we are using, it doesn't calculate it quite accurately. I'm thinking because it's a U.S. edition, it's very close, 1126 it shows here, when in fact our payment is around 1123. So it's off about $3 per month. Really not a big deal in the grand scheme of things, but I did find that fairly interesting that the payment was a little bit off from what ours is. Another thing I found was a little bit strange was the loan balance, the year of the sale. It's showing 252 here. I'm not quite sure why it has that. We've got our sale down here, sale expected at end of year 2011. So basically we're selling it a little over 2 years down the road. It is a rent to own or a lease to own property, so I put that in just over two years down the road. And for some reason the loan balance year of sale is 252. I'm not clear why that's the case, because when I do my own calculations it's actually a little bit higher than that. I think it's around 256. So I would like to ask them how that is calculated and what I'm missing there. It could be a few other things just quickly. Gross scheduled income, you put that in, your annual amount. We're getting $2,000 a month in rent, so that's $24,000 per year. And then you can add in a few different things here: insurance, taxes, other operating expenses. So it's just a really quick analysis in terms of what your expenses will be on an annual basis. And so with all of this, you can really see you can also increase basically just inflation is what this is accounting for. So we've got here insurance increasing by 4% every year, or you can switch this to every month if you wanted to, or every 2 years or 3 years or whatever you want to do. So we just said annual. Then here, this is again a nice feature of this, is selling price calculated. You can't do this, but it's based on one of these three things here. So estimate selling price by, and again we've got our fancy little triangle here that tells you about it. You can either capitalize your NOI, you can appreciate by your purchase price, which is up here at $351, and you can appreciate it by a certain percentage, or you can look at your gross rent multiplier, which we've talked about as well. Now, because we have a lease option in place, we already have set the price at $383, so you can override that. Here finally is capital improvements, 2009, 2010, 2011, none. So again, you can put these in based on whether you think you're going to have to do any work to the property and how much you think that's going to cost. So I just threw in $2,000 next year for various things, maybe fixing up the roof a bit or what have you. Finally, you've got your Cook analysis report. This has a whole bunch of great stuff. One thing I do really like about this, besides that everything is there's formulas already set for you, is if you want to print this, it's all nice and neat on one page. So it's already set up to easily print for you, and you're not going to have any run over onto another page and have to fiddle around with formatting, which is one thing that Julie and I have done over the years, is we've created our own spreadsheets, and we could find this very useful, or we could have found this very useful if we had known about it about 7-8 years ago when we first started investing and putting our own spreadsheets together. So we've developed our own, which certainly aren't nearly this pretty nor this involved, but this is a very handy way to quickly look at a prospective property or even your own property that you already own. So at the end of the day, this is a really useful tool for the average investor, especially smaller investor. You probably don't need to go with the standard edition, which was, $495. It's probably much wiser to go with the $159 version, the Express, which is basically the same as the one we looked at, although it does have a few other features in it. And I'll show you that in a moment.